Okay, that's good. So you don't know exactly what I'm going to say already. So the question is, why don't more people buy long-term care insurance? And we've traditionally gotten different answers depending on who you ask or how you ask them. There's sort of rational answers and emotional answers. Rationally, it just costs too much, right? It's too expensive for what I have available to spend. Medicaid crowd out. Steve Moses and others will tell you that it's all about Medicaid. If that's available, they're giving it away across the street, why would I buy it over here? Is it a misunderstanding of Medicare? Last session I went to basically postulated that. Maybe it's just that people think or they don't know whether or not Medicare covers it. Or is it concerns about rate stability or value? How many people already are aware of rate increase histories, that sort of thing, or things they've read about in the newspaper. So that's the rational side. Then there's the emotional side. It's just, straight up denial. I don't want to think about it. It's going to happen to somebody else, not me. I'm going to die on the golf course. We've heard that. If you've ever done focus groups on the subject, and I'm sure you all have seen it at some point, that's the kind of thing you hear. You also hear things will just work out, which we in the psychology world call external locus of control. Like, things just kind of happen. The stars will align one way or another, and good outcomes will come to me. And then another really interesting one is this devaluation of the future self, sort of imagining yourself in the future and sort of devaluing that person. Like, I don't really respect that myself in the future being disabled, so I'm not going to plan to protect that person. So lots of different answers given by different people at different times. So the question is, what about the role of systematic biases in judgment and decision making? So the reason this came to me is first of all, I picked up this book. And I had done some reading about it back in grad school, this whole issue of decision-making under conditions of risk. Kahneman actually got the Nobel Prize in economics for this theory. Tversky, his associate, would have. Unfortunately, he died. But that's the book. It's a bestseller. Pick it up. It also is something that's been reviewed and covered in the book Nudge. You've seen that, which is by Richard Thaler and Cass Sunstein. Essentially, these two, with Thaler, created the field of behavioral economics. And I'm sure, you hear a lot about behavioral economics these days. Dan Ariely is another person who is associated with it. He wrote Predictably Irrational and several other books. So these are big business books these days. So let me try out something, a little experiment with you here. And we're just going to do a show of hands, okay? Right, pretend that you're a sort of public health physician, and you're presented with this dilemma. There's an unusual Asian disease, and it's expected to kill 600 people, and 2 programs are developed to combat it. Okay? If program A is adopted, 200 people will be saved. Okay? If program B is adopted, there's a 1/3 probability that 600 people will be saved, and a 2/3 probability that no one will be saved. Which one do you choose? All right, how many people would choose program A? Okay? How many people would choose program B? Okay, so A is the winner, right? Okay. Okay, here, same scenario. Unusual Asian disease expected to kill 600 people. 2 programs are developed to combat it. If program C is adopted, 400 people are going to die. Okay? If D is adopted, there's a 1/3 probability that no one will die, and a 2/3 probability that 600 people will die. How many people will vote for option C? 1 person. How many people for option D? Okay?
Behaving predictably.
Interesting. So I guess we don't have a ton of actuaries in the room because those 2 scenarios are exactly identical. And what happens is people, depending on the framing of it, whether you frame it as a gain or a loss, people will behave entirely differently. So when those exact scenarios were presented to real public health physicians, guess what? 3/4 of the folks picked option A, 1/4 picked option B. Option C, only 1/4 picked, less than a quarter. The remainder picked option D. So this has real world implications. How you frame something actually affects even how experts behave. Why does that happen? Well, there's a thing they call in psychology having a gain frame or a loss frame. It's a framing effect. So if I frame something a certain way, you're going to think about it a certain way, and then you're going to react a certain way. More generally, what we see is that losses weigh heavier than gains. So losses are more important to people than gains. This is a general phenomenon that they call bad is stronger than good. There was actually an important psych paper that was published with that title, Bad is Stronger Than Good, and it reviewed all the evidence. People can pick an angry face out of a crowd of neutral faces like that. It's like, bing, you see it. A smiling face in the same crowd of neutral faces, you just don't see it nearly as quickly, right? So bad is stronger than good. In a healthy relationship, it takes 5 times as many positive statements to one another than for each negative statement to keep it at the sort of, in a happy, stable relationship. Why should it be 5 to 1, Right, exactly. Sounds right. So this is the evidence. So bad is stronger than good. So here's prospect theory. Built on 3 psychological mechanisms. First of all, people are sensitive to changes from the status quo, so gains and losses. They're not really sensitive to where they started from. Okay? It's just all about change. Secondly, people show diminishing sensitivity. So what's $100 worth? $100 going from $900 to $1,000 appears a lot smaller than going from $100 to $200. Okay? And then third is the one we just covered, bad is stronger than good. Losses are more painful than gains are pleasurable. Okay? So what does this mean? You can plot this out. This is what prospect theory would say. So imagine a scenario. First of all, what we have here is the psychological impact, positive and negative, on the y-axis, the vertical. Okay? And on the horizontal, we have a dollar amount change. So we're starting here right at the midpoint at a 0. So you've got whatever money you've got, and I give you $100, and boom, it moves up. So that's a good thing, right? There's a positive psychological effect. If I give you $200, it doesn't double the psychological pleasure. It should, but it doesn't. It kind of levels off a little bit. The interesting part is what happens on the negative side. If I take $100 away from you, you've lost $100. The psychological impact is twice as big, twice as negative, right? Just losing that $100 drops you down. But then if you lose $200, it's worse than losing $100, but not twice as bad. Okay? That's the general principle here. And you can see this applied in a lot of different scenarios. So if we were perfectly rational decision machines, we would basically apply decision weights that would equal the probabilities. So as things became more probable, we would add more weight to that thing. And as they became less probable, we would subtract weight from that decision. And our decisions would fall right on what we call the rational utility line. But because we're emotional beings and there's that sort of right, side of the brain being shown as being much more exaggerated than the left, we see that people are actually quite irrational. We have this irrationality curve, irrational utility curve. And this explains a whole host of things. For instance, the chance of terrorism is very low. Somebody might still avoid flying. This happened after 9/11. There were a whole bunch of car accident-related deaths that were unnecessary because people were choosing to drive instead of fly. The risk of an appliance failure is very low. Still, you decide to buy the extended warranty. The chance to win $1 million in the lottery is very low. Still, you buy a ticket. So people do a lot of things because they're overvaluing very low probabilities. On the flip side, they tend to undervalue very high probabilities. Let's say you're about to be awarded $1 million in a case that is pretty much a lock. What happens is, in almost all cases, people will take a settlement. They'll say, okay, we'll guarantee you $800,000, for you to walk away. And people would generally take that, even though it was, certain that they'd get the $1 million. A more extreme example, someone's about to go bankrupt at a casino, so they take a short-term loan from the mafia and bet it all on the roulette wheel. This kind of thing happens, and you see it a lot in game shows. Deal or No Deal is a perfect example of it, where people will kind of make all kinds of crazy bets because they want to, they're kind of discounting high probabilities. So this is all encapsulated in what Kahneman and Tversky called the fourfold pattern. So what they've done here is the rows are probabilities. High probability is the top row. Low probability is the bottom row of the event occurring. And then it can either be expressed as a gain or a loss. And what we see here, first of all, is the first line under each tells you what's going on. So top right, a high probability loss. It's a big risk to lose a lot. Okay? If we kind of follow it down, the columns, the rows underneath it, that means you're hoping to avoid a large loss. That will generally generate risk-seeking behavior. Okay? An example would be rejecting a favorable settlement. For example, the casino evening that I talked about. Okay? The left here, high probability gain, is a big chance to win a lot. Not lose a lot, but to win a lot. So psychologically what's going on there is you're afraid, your fear of being disappointed. So you suddenly become risk averse. So you accept an unfavorable settlement, for example, the court case. Bottom left, low probability gain, small chance to win a lot. Okay, this is the lottery. Hoping for a great gain, it promotes risk-seeking behavior, rejecting a favorable settlement. And then the bottom right, is a low probability loss. a small risk of losing a lot. The mechanism there is it's fear of a large loss. People become risk averse. An example there would be insurance. Okay, so that's the basic pattern we're going to use. So what we did was a very large-scale study of 1,600 people, online survey, where all we did is serve up one of these options to them as sort of a positioning for long-term care insurance. That was the whole manipulation, and all these cells were balanced to be the same demographic groups. And we cut it by age bands, every 10-year age band, from 20 to 80 or something like that. And we basically expressed long-term care insurance in terms of those different ways of seeing it, as a kind of a high or low risk, and whether it's a gain or a loss. So let's take the top left. A high-risk gain. This policy will pay you, $4,500 a month. 7 in 10 older Americans will use some form of long-term care, so there's a high probability that these benefits will be paid out. So it's about a gain and a high probability gain at that. Let's take another example here, the high-risk loss. Long-term care insurance expenses represent the single biggest risk to your retirement income and security. Average lifetime loss of $63,000 in nursing home costs alone. 7 in 10 older Americans use some form, so you face a high risk of experiencing a substantial loss. So you get the logic of this. So it's teed up different ways. The dependent variable we're looking for here is what people are willing to spend on long-term care insurance. And of course, as you would guess, we had some predictions, and here they are. What we predict is that the top right is going to promote risk-seeking behavior, which would be expressed here as less willing to pay the full premium. Okay. Similarly, the bottom left, that lottery scenario, will promote risk-seeking also, less willing to pay the full premium. Top left will be risk-averse, willing to pay a higher premium, and bottom right will be risk-averse, willing to pay a higher premium. And going into this, I didn't know, is this going to be a strong enough manipulation? Are we actually going to see real differences? And lo and behold, this is what we got. These are the ranks in terms of what people are willing to pay on average across the whole sample. Okay? So what we see here is number one, willing to pay higher premiums occurred in that bottom right corner, which is where insurance is typically sold. So it's a low risk. You're buying insurance to insure against a low risk probability. They're willing to pay the highest premium there. Top left came next, high risk gain, surprisingly, expressing long-term care insurance as a gain. Again, willing to pay higher premium, followed by really pretty much a tie between the top right and the bottom left in terms of risk seeking, the least willing to pay the full premium. Okay, make sense? And then we cut it by age, and we see some interesting patterns here as well. Top right is the high-risk loss. That actually had the most cases of age bands in which it came in last place. Because a couple of them came in second place, it ended up falling into the third position, but essentially it had the most last place ratings. The one just below that, the low-risk loss, had the most first place ratings. Okay, and we see some things going on by age as well. If you compare the top left to the bottom right, the older folks, the 60 to 79-year-olds, they liked the idea of the low-risk loss better. That was more motivating to them, whereas the younger group, 59 and below, 30 to 59, were more likely to be motivated by the high-risk gain. So some little subtleties that are kind of creeping into this. So what are the implications of this? First of all, long-term care insurance industry traditionally has loved high-risk loss. That's how it's always been positioned, particularly in written materials. And I've taken these sort of just screenshots from different sites I went to. And I'm certainly, have been someone who's been involved in producing these kinds of graphics over time. I never really thought about it this way until I did this research. But essentially, this thing where we say, are you willing to take the risk? There's only this percent, chance of having a house fire. And, with this small loss and an auto accident, but then, a 60% chance you're going to need long-term care insurance in your life and this huge price, that's high-risk loss. And we show it that way, and we show it in that graphic. The implication is that that's a deeply flawed strategy, that is exactly the opposite of what you should be doing. Okay. And Kahneman in his book, writes about this pretty clearly he says what's really going on is that your emotional response is the mediator here. And that's what's really going on in the different quadrants. I won't take you through all of them, but essentially in that upper right quadrant, really what you're emphasizing is the anxiety of being trapped in a desperate situation. When people feel anxiety about being trapped in a desperate situation, which is what all that high-risk loss says, they do all kinds of crazy things. They take their chances, and they shouldn't, but they do. So since it's all about emotion, we wanted to throw another couple of conditions in here to test that really explicitly get at emotion. So will a strongly emotional framing of gains versus losses be more effective than this? Because that was all pretty, cut and dry. It was all statistical, analytical. Let's go for something way more emotional. So we tried two more conditions here. An emotional story-based approach with no probability information. The events that were described have already happened. So we have the gain story. So Mary sees husband John experience a debilitating stroke at age 63. They moved into a one-floor condo close to their children. Even though he was confined to his better wheelchair, it was very important that he be cared for at home. Fortunately, we had purchased long-term care insurance policy several years earlier. The extra $4,500 a month meant that I could hire da-da-da-da-da. You get the point. It's a positive outcome. The loss story is the same thing, same characters, same ages, everything's the same. Unfortunately, we had passed on buying long-term care insurance several years earlier. Medicare did this, left us with the stress of that, costing us more than $5,000 a month. A large part was wiped out, etc. So it's the same scenario. One had long-term care insurance, one didn't. We were curious to see what this would do to our premium willingness. And what we see is it basically put the other ones in the dust. The emotional story, the loss was number one, willing to pay the highest premium, pretty much in a tie, a little bit higher, but pretty much in a tie with an emotional gain story. So this isn't news to anyone probably that, having an emotional story is going to be more powerful than statistics, but it's not something that Kahneman predicted in his book. And it was something that's kind of a real world application, so it's kind of interesting to kind of put it all into context. When we look at it by age group too, we see some interesting things. I think the most interesting thing to me is what happens with the guys who are the oldest, the 70 to 79-year-olds. So they don't really follow this pattern. So we see a lot of green. The green means, that was people willing to pay more in those age bands. What we see is that the 70 to 79-year-olds don't follow that pattern. They're a dark blue in the top right. Where are they high? They're in the very bottom, the sort of low-risk loss scenario, right? Why is that? Well, again, we return to a different psychological theory for that explanation, and it's this one. From Irving Janis, 1967. If you took, Psych 101 back in college, this may sound familiar to you. What it's doing is comparing essentially attitude change on the y-axis against the level of fear arousal on the x. So what we see is, as you get closer to needing long-term care, the more fear arousal backfires. So a very kind of dramatic, compelling, emotional story of loss when you're in your 70s is just creating too much anxiety. So what we see is, if we kind of plot out what they liked, emotional gain, low-risk loss, those things did the best. As you push it further to a high-risk loss and emotional loss, you've gone too far with that group. All right, it's too scary. They shut it out. Okay? So, final page here, do's and don'ts. Stop emphasizing high-risk loss scenarios. That's the big takeaway. If you take away nothing else, that's what I want you to take away from this. Okay, do use emotion, particularly an emotional loss story for middle-aged prospects, those 40 to 69. Okay, they can handle it. For the oldest group, be mindful not to scare them. Use emotional gain stories or low-risk loss scenarios. And also use, I didn't really call this out too much on the slides, but it's all in there, use a more analytic approach with people who are under 40. They didn't respond as well to the emotional story, did respond to the high-risk scenarios. The hypothesis, maybe that was because the story wasn't really tailored to them. They kind of left an open research question. What if we had the emotional story be about an accident happening to a younger person? Would that have tipped the balance? It probably would have. We haven't done the research, so I won't say for sure. But that's it for me. I'll turn it over to Clark.
Thank you, Jeremy.